Good morning. Welcome to Market Monday for December 18th, 2023. We hope you had a happy Hanukkah for those who celebrate. As we begin winding down 2023, here are some thoughts about what may lie ahead in 2024.
We've seen inflation come back down significantly from the highs in the summer of 2022. If you recall, first it was goods inflation that skyrocketed, mainly as a result of COVID. Then services inflation caught up and has also been coming down very close to the Fed's long-run target.
And let's remember, the Fed actually has a dual mandate. For the past few years, we've all been focused on just one of them, inflation. But with most of the big inflation risks behind us, we could see the Fed begin to shift its attention to its other mandate, full employment. Employment has been under 4% now for 22 straight months, the longest streak since 1960s.
Under 4%, but increasing. And we know unemployment is a lagging indicator, meaning unemployment is always very low when recessions start and always high when recessions end. Those are characteristics of recessions, features. And as a certain segment of consumers, namely the lower incomes, the ones with lots of personal debt, high auto payments, etc., are definitely becoming stretched, will it be enough to tip the entire economy into recession? Have a look. We certainly see increasing delinquencies, but coming off the rock bottom, and perhaps just coming back up to the pre-COVID trend.
The United States Treasury is paying out about $1 trillion a year in interest alone. And while we leave the morality judgment up to you, for us, we see it as $1 trillion give or take being added to the real economy. Add to that over $1 trillion of Social Security and increasing again next year. With slowing inflation, and we do see that as a ballast against a significant crash. Again, this concept of rolling recessions where certain segments of the economy slow down or enter recession, but not enough to tip the whole economy into recession at once.
But isn't it true that a lot of recessionary indicators were triggered over the past few years, namely the inverted yield curve? Doesn't that have a very high success rate of predicting recessions?
Yes.
But hasn't the S&P 500 stock market delivered positive returns in 10 of 10 prior election years for a first-term president?
Also, yes.
So what gives?
Well, both can actually be true. Here's a quick look at those previous 10 election years under a first-term president. We see some red, see some blue. Here are the pre-election years like we're in now. We've been talking about pre-election year seasonality being positive all year long. And here's the election year itself. 10 of 10, not too shabby.
And remember a few weeks ago when we looked at recessionary periods? Most recessions aren't the global financial crisis or COVID crash. Here's GFC and COVID. But look at most other recessions. Certainly in the past 50 years, usually in the down 2 to 3% range. But not just that. Remember that the stock market was actually up before and during recessions about half the time. And how about 1 year, 3 years, 5 years, and 10 years after? A sea of green.
And another reason for an open mind about a positive market next year is that year 2 of a bull market is also usually positive. Here's the first year, a lot higher, coming off the bottom, rewarding those who stuck with it. But year 2 isn't too late. Of the 12 prior such periods, the average second year gain was 12.6%. No guarantees, just history and context.
Have a great week.